Hello, this is Vlad, and today I'm going to be interviewing who David Wield IV, actually, who is a stock market expert, and he served as vice chairman of NASDAQ, but he also helped draft legislation in the US Congress, and he is considered to be the father of the Jobs Act during the Obama administration in 2012, was it?
Yeah, it was April 5th, 2012 that it was signed into law, and I was in the Rose Garden of the White House for the signing. It was a lot of fun.
Okay, so the first question which I'm going to ask you is about Bitcoin and what you think about it, or maybe what you thought about it while you're still at NASDAQ.
Well, gosh, I mean, I think Bitcoin actually came after my time at NASDAQ. So, you know, I think my impression of it is it was actually, pretty innovative idea, but I also was more concerned about how Bitcoin would be abused for money laundering purposes and the like. And so it was, we own an investment banks called Weild Co. in the United States, and I get very concerned because in cyber wallets, you can't necessarily get a copy of a statement to monitor, what people are actually doing. I think that was one of the sort of advantages, at least to some people, of Bitcoin. And obviously, I was a little bit concerned about how it would be abused for drug trafficking, financing of terrorism, and things like that. And so I think that governmental entities are starting to catch up, and I think they're on the chase, and they've developed, an increasing array of technologies to be able to sort of track. Obviously, there are some implications to tax evasion as well. But in the end, I mean, I think cyber currencies have some utility. I mean, they can, certainly help with things like micropayments and the like, and facilitating, payments, in a wildly distributed environment. And so I think that they're here to stay.
I've asked this specific question because until maybe a year or 2 years ago, there was this rhetoric on Wall Street that Bitcoin is a Ponzi scheme, a pyramid scheme, and you still have people like Nouriel Roubini or Stiglitz, who is a Nobel laureate in economics, and they seem to have these views which maybe they're not very well informed, in the sense that they don't really understand how blockchain works. They just promote maybe a shallow perspective on what they understand of it.
Yeah, I think that they overthink it a little bit. I think that currencies, whether they're cyber currencies or fiat currencies, they have value because people believe they have value, right? And if you want to use the U.S. dollar and you believe it has value, you're going to hold and store U.S. dollars. If you believe that that Bitcoin has value, you may hold and store Bitcoin. And I think that it served a function. I mean, clearly, the basic thesis that you couldn't print more Bitcoin, flood the market with a supply, and so consequently it might become a more stable store of value is really, I mean, if people believe that, then Bitcoin will have value. I mean, there's also this whole issue of custody, which hasn't quite really evolved in the United States, which is important for tokens as securities as well. And I think that there's a lot of money on the sidelines still that doesn't participate in things like cryptocurrencies and tokens as securities yet, because they have to figure out, how do you store stuff and avoid the risk of loss, right? You don't want to lose your, if you have Bitcoin on a computer and you lose your computer, you lose your Bitcoin. And so I think that for professional money that really wants to, in many instances, and is acting as a fiduciary and representing the interests of other people, I think that that's a non-starter. So I think as soon as we figure out sort of safer forms of custody, and I think you'll start to see larger amounts of professional money move into these kinds of asset classes. And it doesn't take a lot, to cause Bitcoin or tokens of securities to appreciate in value. I do think that tokens of securities is a completely different thing. I think people will look at the underlying assets of those particular situations and evaluate them just the way that they would evaluate, any kind of a security, and the underlying entity and its growth rates, whether or not you have a dividend associated with it, a revenue strip. And I think that people will just start to ask the question, why should I own something as a token versus a traditional security? And many times the answer is going to be that there's a lot of back-end processes that are associated, so it's going to facilitate trades, transacting, ownership, a variety of things, multi-jurisdictional, interjurisdictional compliance in the case of private markets, so on and so forth.
I've been waiting to ask you this question because I wrote an article about it, but there was this college kid who basically bought cryptocurrencies at a low price in 2017. And by the end of the year, he was, when Bitcoin was $20,000 and all the coins were just at the top, his investment was worth, I guess, $800,000, but he invested $2,000. And he engaged in some trades and he got to that amount, but he never cashed out, as in he is still holding the coins. But he received, I'm not sure what it's called, like a tax file from the IRS, and they asked him to pay $400,000, which is half of the maximum amount which his investment was worth. And that's just because he did some trades, and the legislation of the state of California understands that each cryptocurrency trade is something which should be taxed, like a taxable event. And to some, it felt outrageous because he never took the money out. It's like buying stocks and just trading them, and he just held stocks or cryptocurrencies. He never cashed out in US dollars, but at the same time, he has a huge debt in US dollars.
Well, I think if he bought it and held it, I don't think that I'm not a tax attorney, that would be a taxable event, and so, if you bought it and sold it and realized the gain, then there probably should be. I don't think that there's anything that I'm aware of in US tax code where you buy something and you're subject to a tax on it before you actually sell it. And I don't know what the theory would be under which the IRS would try to impose a tax without him having realized profit on it. But it's sometimes governmental entities try and make a point, and I hope he has good counsel. But I suspect that if he's a kid and it goes to court, that most judges would smile kindly on him, and so I think it makes probably better headlines than it is an actual problem in fact.
Yeah, he actually posted his story on Reddit, and it made the rounds within the cryptocurrency community, just because some people got worried and they said, okay, I'm also from California. I've also engaged in cryptocurrency trades. So does it mean that I should expect to get the same kind of invoice to pay to the IRS, a high amount, which is evaluated according to the top, not to the actual holdings or how much they are worth right now? Right. Because he was basically saying my life is ruined because I have this huge debt and there is no way I can ever pay it.
Yeah, well, again, Vlad, I don't know the specifics, and I haven't read that particular article. I don't know the facts and circumstances. I thought that the bigger issue with cryptocurrency from a tax standpoint was whether or not you were going to be taxed on individual trades, and which adds frictional cost to it. I don't know that you. When you use currency, typically, I don't think, you receive it, you buy it, you sell it. You don't necessarily, unless you earn it. I don't know that you get taxed on it. So, but this is the bigger, broader problem, with this whole area, including initial coin offerings. I know we in our investment bank, I mean, literally 3 months before SEC Chair Jay Clayton came out and said that he hadn't seen a token that he didn't think, or an initial coin offering that he didn't think was a securities offering, we had told everybody in our investment bank that we were going to treat them as securities offerings, because it was fairly clear to us when I was reading white papers that that they really didn't do anywhere near an adequate job of disclosing in those white papers what people were buying. I mean, describing what they were buying and what the risks were associated with them. There were no risk factor sections, and I candidly read a bunch of them, and I really didn't understand them. And I've been doing this for a long time, Vlad. And I was in a top 10 investment bank in the United States many years ago. I ran investment banking, I ran equity capital markets. I priced 1,000 public equity offerings. Some of the notable ones, I took Celgene public, or I did an equity offering when it was $100 million. Is now a $60 billion company. I worked on NVIDIA's IPO for Jensen Huang, which was the 3D chip semiconductor company that is used in gaming, and a wide array of things. Some very large energy companies. I mean, companies that have done incredibly well. I did an early deal for receptor technology in life sciences that was ultimately bought by Amgen and made Amgen, from what I understand. So, when I was at NASDAQ, I dealt with, I talked to Steve Jobs. I joked with people that I'm the reason why the iPhone has email on it, because believe it or not, Steve called me. I used to joke that I was the complaint department for Steve, and he called me up and he said, "I just discovered that that NASDAQ is standardized on Dell laptops, Dell computers, and if you don't move over to the Mac immediately, I'm moving my listing of Apple over to the New York Stock Exchange. I'm leaving NASDAQ." And I said, "Steve," I said, "we love the Mac. It's in the graphics department, and but we can't use it with the sales and service side because they're out traveling a lot, and it doesn't integrate with BlackBerry, and everybody's using email on BlackBerries to communicate." And he didn't know that. He literally didn't know that, Vlad. He did not know that. It just shows you that people that are absolutely brilliant and successful, sometimes just by sheer force of perseverance and staying with something, they don't know everything. And you hang around, and there's a basketball analogy I like to use, which is you hang around underneath the basket long enough that even a short person is going to catch a rebound now and then amongst a field of giants. So, I've seen lots of instances where sort of titans of industry, absolutely brilliant people, completely miss things. Craig Barrett, who was a PhD out of Stanford, ran Intel, and I was in his offices, in Intel's offices in Silicon Valley, and he mentioned, this was before Apple took off, that Steve Jobs was really good at figuring out what that 3% of the population that didn't want to be like anybody else wanted to do. That was his core competency, basically trivializing, Steve Jobs. And then, of course, the rest is history. I mean, it became market capitalization ended up dwarfing that of Intel. So, it's everybody. These businesses are made up of human beings. Sometimes we have a moment of brilliance. But a lot of it doesn't come easy. And you work hard at it, and then a little bit of luck comes into play, and then maybe you build something which is remarkable. But maybe we get back on the subject of crypto, and
yes.
Yeah.
But I guess you presented a larger criticism, which we also have in the crypto space, about Silicon Valley being so eccentric and sometimes out of touch with reality. Because in 2017, they promoted some very ambitious projects, which were promising to do very much, but they ended up being flops. And you had people like Naval, I'm not sure how you pronounce his last name, but he's one of the biggest angel investors in the space. And he was basically not spending, but investing a lot of money in projects and advising them, but most
Yeah.
of them just didn't succeed. And I think Ethereum and Zcash are the only ones which are still around going strong.
Well, look, I mean, I think that the block and crypto and everybody looks at this stuff as being so revolutionary, but there isn't much that's revolutionary. It's evolutionary, and the plight of startups is that most startups fail. Right? Doesn't mean that we don't do them, because ultimately, if we get up, and swing the bat, get up to bat enough times, eventually we're going to hit a ball out of the park. We'll hit a home run. It is, but it's a lot of trial and error, and you've got both business and execution risk, and you've got financing risk. And if you don't add adequate resources, then you can bankrupt a company. And if you have adequate resources, but you don't know what you're doing, you can bankrupt a company by chewing through those resources. And those are that's how companies fail. And but I mean, it's sort of interesting. We talk about Intel. Intel went public in 1971, and it was only a $9 million IPO. It missed delivery on its first product. Okay, so it was pre-revenue, and it lost 70% of its value. And it was a little company, and it was teetering, if you will, on the brink. It could have gone bankrupt, and it didn't. And obviously, that company and its technologies permeate everything. And when you talk about what's evolutionary, without the semiconductor and the explosion in semiconductors and Moore's law, effectively causing greater and greater computational power, year after year after year, we wouldn't have the processing power that's required to do something like crypto. And then if you go and you look at distributed networks and the internet, going back to DARPANET, I mean, that stuff started in 1961. I believe that that was the first connection between two computers talking to each other, which is the precursor to the internet. I mean, it's taken years and years, and we now take for granted the fact that the internet is sort of this ubiquitous technology. I mean, it's there, and we use it. But without the internet, you wouldn't have, and without without storage technologies and the like, you wouldn't have Bitcoin. So I think that the original paper on blockchain and distributed ledgers, that was the sort of the foundation to Bitcoin, I believe, happened all the way back in 1991. It was published. And so as a consequence, it took many years to get Bitcoin off the ground. It didn't just sort of, suddenly erupt. It did erupt in terms of people's consciousness. So, it's the amazing thing about society is that, the more intelligent, educated people there are, the higher the likelihood that we're going to see acceleration and change, right? Because there are more and more people working at these problems. And, this is an amazing age that we're going into. I mean, it wasn't only in the 1950s, I think, that Watson and Crick discovered the double helix. And if you look at what we're starting to do, finally cracking the back of cancer therapies with cancer immunotherapy, that highly targeted, highly efficacious treatments for cancer, starting to understand the genomics underlying cancer, and the fact that what we up until this point understood to be, for instance, one disease, actually many times may be 5 or 6 or more different gene states that are presenting themselves as one disease, and in point of fact, they're really 5 or 6 different diseases. And so, we're starting to take the glasses off. We're starting to be able to see clearly, and a lot of it happens to be because of this kind of convergence of a whole range of different technologies that are coming together, and finally creating a tipping point in terms of what is possible. And it's a very exciting time in history. in many respects. I mean, artificial intelligence, I mean, quantum computing, is one of the concerns, but, I think that we have on, in Bitcoin is you get a key. And my understanding is that while quantum computing is very unstable still at this point in time, that people have been able to crack these so-called immutable tokens using quantum, computing. So, we'll have to see, how stable some of some of these systems like Bitcoin turn out to be over the long run. I'm not sure that they will necessarily stand the test of time.
Yeah, I guess that's one of their concerns as cryptographers, because right now Bitcoin is encrypted by SHA-256, which contains 256 bits, which means they have, I don't know how many possibilities. You just have to multiply all the numbers from 1 to 256 to determine the number of possibilities that you have in order to crack one code. And I guess with quantum computing, you have higher chances of decrypting, and that's what their worries are. But at the same time, they are very confident at this point that no network of computers can actually decrypt that amount of data, because we don't have the computing power up to this point. But for the moment when that happens, I think they have something prepared to change the algorithms and use something which is much more advanced. So they already thought about it, and it's a big discussion in the field. But I wanted to ask you about mining, because this is a big issue. It's maybe something which comes up as an environmental problem sometimes. But there is this company from China, which is called Bitmain, and they are known for producing what they call ASICs. They are specialized computers, which basically are designed just to mine. They're not good to operate anything else. They just have a high hashing power to mine. And today they are trying to go public, and they are trying to get listed on a stock exchange. And some people call it, I don't know, maybe the critics say that they just want to get rid of their assets because they're not as profitable anymore. And they're trying to find some fools to buy stocks in their company so they can run away with the money. While others think this is a future big investment.
Right. Well, I think that to the extent that the decentralized distributed application of and use of mining effectively to verify and enforce in blockchain, becomes sort of the standard. There is a real need to keep the amount of compute power because of the environmental, risk, but also because of the cost. I mean, the notion here in the United States is that people move up to Canada because there's a power arbitrage, and at some point, if there's enough mining, that arbitrage in terms of the cost disparity between the two markets is going to, disappear. But I think that there's also a lot of sort of, what I would call libertarian ethos, underlying much that goes on in the block, that that networks need to be almost anarchist and not regulated by anybody, and highly decentralized. And I know that I've heard that from Lubin, who was a co-founder of Ethereum, and I think that people, at least in the securities industry with the application of blockchain, don't believe that that's the case. And in fact, a lot of people are of the mind that greater centralization, or maybe just making something multi-nodal as opposed to sort of almost ubiquitous and everywhere, is a better place to go, because you can manage the costs, the environmental aspect of it, but also because there are certain types of, like, for instance, securities applications in the securities industry that really probably benefit from being centralized and or more centralized. and also that you know, that in industries where you're applying blockchain technology, where rules change, which is clearly the securities industry, you know, setting something off on autopilot, one size fits all, and just letting it run doesn't work, because somebody's going to have to change the rule book at some point in time when the regulators change the rules, which they will. So, but I don't. You know, I haven't looked at the specific, you know, demand. I suspect that people are going to start to move away from mining as a methodology for other applications, just because I think it's not particularly efficient. Not, you know, it consumes a lot of energy and resources and so on and so forth. And my suspicion is that that there'll be innovations around that verification process that will move us away. But obviously something like Bitcoin, which has been sort of set on autopilot and exists, you're not going to change that. And what I find, you know, when you look at processing on Bitcoin, I think people, I've heard that you can process 3 transactions per second. And I mean, in you know, in the world of credit cards, and that's nothing, right? It's just not enough throughput, and so you know, it'll be interesting to see if, you know, over the long run, you know, Bitcoin has you know, the utility for a lot of applications, or if it itself, because of the way it was structured, although highly innovative and really kind of fascinating, it doesn't really meet the needs of a broader market when you start to apply it broadly. You know, it's a currency, but it's a technology too at the same time, right? It has utility to it in terms of, you know, in facilitating transactions, and if it doesn't scale, or it can't be made to scale, or it's not as efficient as some other things, or it's not as useful because it can't be made to comply. It may find a market, a niche with some of the libertarians out there, but it may ultimately end up not being the most prevalent cyber currency in the marketplace.
I think this is what they call in the industry the scalability trilemma, because you cannot have a system which is simultaneously, or you can, but it's very difficult to have a system which is simultaneously decentralized, which is immutable and scalable. You need to compromise on one aspect to be able to create a system which is functional. And with Bitcoin, they have 2 schools of thought. They diverged and they found 2 paths to go on. Right now, there is Bitcoin Cash, which said that they're going to scale according to Moore's law, and they are going to increase the size of the blocks so that they can enable more transactions. Right now, I think they can process up to 100 per second. But the criticism regarding Bitcoin Cash is that the more they increase the block size, the harder it is for a normal person to participate in the system. They have this consensus system which says that if you run a node, which means that you store the whole blockchain on your computer and you validate transactions. If you run a node, then you have something which is like a voting power, because by running it, you accept the protocol and you don't want it to change. But if somebody wants to change it, you can just opt out and say, I'm not going to update my protocol because I like this one. And with the Bitcoin network that we have right now, they're trying to build what they call Lightning. And up to this point, it's functional, but it works on a very small experimental and developer scale. They figured out many aspects of it, but it doesn't have like a friendly interface up to this point. And they say that it can handle more transactions than Visa, and they can do any transaction with the cost of 1 cent.
Right.
And I guess that's why Bitcoin is still valued so highly, and they have high expectations of it, just because they have a second layer, because they said we're going to keep the main blockchain, which is going to remain the same, and we're going to build something on top of it, which communicates with the main blockchain. And that's our scaling solution. They just said, instead of increasing the blocks, we're going to build a separate network, which is going to operate with the main one.
Right, and you know, and you're going to see those kinds of innovations around it. I mean, at the end of the day, the fundamental question is, does it work well enough, and do people have confidence in it? And it's that confidence issue. Is what do people, it's got the biggest brand by definition, right? So I think that if, people start to become enabled to buy Bitcoin or any of these cyber currencies as an asset class, I think that one of the big, asset class, or the big cyber currency that's going to be a beneficiary of a lot of the inflows will be Bitcoin, because it's got the greatest mind share, and it is, if you will, it's sort of the Apple of cyber currencies at this point, right? But I do think that, as time goes on and people become more and more accepting of cyber currencies and understanding of blockchain, just start to take some of this stuff for granted, just the same way that we do the internet. And we don't talk about how the internet works anymore. It just works, right? And I think we're going to get to that same point with crypto, cyber currencies, with tokens of securities, and so on and so forth. At some point it'll go, it just works. This is the solution that we use, and brands are going to matter. I mean, they always do. And but I do think along the way we're going to have some questions about what is the integrity of these systems, and if it turns out that all of the mining gets done in one locale by one business, where there's a big concentration of it, then the question is, is there a power there that is outsized, that going to have a deleterious impact on the underlying cyber currency or whatever is being traded? And I think those are all legitimate questions, and I think we're still in the comparatively early throes of sort of figuring out. But it's still one great big experiment, and my guess is that you got another 5 or 6 years to run before a lot of the basic questions are, from a technologist perspective, sufficiently resolved, and so that there's widespread acceptance about what the requirements are. But I think you're starting to see major institutions and their technologists get involved in looking at a lot of this stuff, and their methodology, because they have to get it right. They're much more buttoned down. They're not the first mover. They're going to go in and test, prod, and before they put customer funds in these kinds of things. And so, when you look at the retail brokerage industry in the United States, which is a warehouse, if you will, for value, right? Securities value mostly. I think that the large securities firms and probably large, deposit-oriented banks are sort of wondering, okay, what are we going to do with cyber currency? Because if it starts to become large enough, we don't want to see a lot of customer assets flow out of these firms, and that will put pressure on them to get involved. My sense from talking to people is they're already, deep looking at it and trying to understand how they can do it in a way which protects the customer, because if they don't get it right, they will have significant liability, right? And you can't have a technology snafu and lose a bunch of Bitcoin if you're a custodian and not be held liable by your customer, right? If you're a clearing organization, if you're a so-called fiduciary. And so I think that what will become really, really, really interesting from a a market value and appreciation perspective is how all of these cyber currencies are affected at the point when the big institutional money and the big retail money from the major Wall Street and money center banks really starts to more ubiquitously become involved in enabling those customers to access tokens, cyber currencies, and so on and so forth through their traditional interface. And I think that will happen. I mean, it's a little bit like manifest destiny. It's going to happen at some point, but they're not going to do it unless they really have crossed their T's and dotted their I's and feel that nothing could blow up on them.
Well, let's talk about regulation, because that's a big topic.
Yeah.
And I think there are two types of regulation. On one hand, you have decentralized cryptocurrencies like Bitcoin, which need a special kind of treatment. And on the other hand, you have tokens and maybe securities which were issued through ICOs.
Right.
And I know that 2017 was this big explosion of ICOs when people were trying to basically bypass regulations,
right,
and try to start a business by getting funding in a way which was not regulated, and they were not compliant to maybe have all the paperwork or do all the bureaucratic means, which usually resulted in a failure and investors lost their money. So how would you regulate if you were in charge of doing it? What would you change about the way Bitcoin is handled, and what would you change about ICOs?
Well, I think first of all, to understand the regulatory process when something new emerges is it's iterative. People take a while to try and understand really what it is, and so it's regulators are not the first movers, right? And they're playing catch up. But the interesting thing is that when you watch regulators, they don't really feel compelled to act. They're the regulator, and they're responsible for making the rules, and the courts are responsible for enforcing the rules and the laws. The regulators are responsible for interpreting the rules that are on the books. And so they could sit there for years and then wake up one morning and decide to come out, or they wouldn't wake up, but then just come out and say, you've all broken the law and we're going to prosecute you. So it puts in a highly regulated industry, which is anything that deals with financial matters, right? Everything from currencies to and the transport of currencies, the detection of those currency transactions, to securities, which tokens are. It's any kind of cross-border commerce, and that includes in the United States amongst the states, right? We call it interstate commerce in the United States. It puts a real onus on market participants to be conservative and to anticipate how regulators are going to treat these things. And I think that what we saw at the very beginning is a lot of cowboyism. I mean, people just shot from the hip and shot from the lip, and I saw that down in Silicon Valley likes nothing more than to run around and to say we're going to disrupt everything. Well, you just don't disrupt regulation. I mean, that doesn't end well for people, and that's exactly what some of these folks were advocating. And so I think that I think you've got legions of governments and regulators who are thinking about it. I think that they're talking to each other, government to government, and I think that they are very methodically going about developing kinds of a consensus, if you will, and standards. And I think that everybody will ultimately regress towards the mean. In other words, that there will be a consensus. We're not going to be able to jurisdiction shop because, for example, if something lists in Malta or it lists in Switzerland, you still have to be able to transact, because most of the money is outside of Malta and Switzerland. You still have to be able to transact cross-border. And so the Swiss authorities are not going to get a hall pass. They're not going to be able to, detach themselves from what the rest of the world is doing, because the bigger markets will assert, jurisdiction one way or the other. I mean, if you look at what happened with Switzerland and the protection of the private numbered Swiss banking accounts, and there were a lot of U.S. tax evaders that were using Swiss accounts. And I think that the U.S. government, ultimately asserted jurisdiction by threatening to capture Swiss assets that were here in the United States, including things like UBS's, UBS owned, bought Payne Weber in the United States, for instance. And there's a multitude of ways that jurisdiction can be asserted over assets, confiscating assets for one. And so I think that you are going to find that, over the next, 2 to 3 years, that all of these sort of legal standards are going to be pretty well ironed out, and there's going to be convergence. And I think that this whole movement towards anarchy is not going to end well for the anarchists.
Okay.
Be my prediction. I mean, the governments are not going to allow people to launder money, and either they're going to develop technologies, in the defense intelligence agencies to track flows or of cyber currencies, or they'll figure out another way to to get on top of it. But they're not going to let people fund terrorism, fund drug trafficking, fund arms trafficking, and kinds of things that sort of undermine economies. It's just not going to happen. And of course, we also have to worry about trade and taxes, right? I mean, the government is not going to allow something to grow and facilitate commerce in a way that buys and sells and gains and losses can't ultimately be verified, I think. So there's going to be an awful lot of catching up that occurs. We've already seen some. I mean, in the United States, the SEC, I believe, served over 100 subpoenas in the wake of the initial coin offerings. And we've also seen state jurisdictions like Texas clamp down on a cyber currency fraud that was perpetrated by a Russian company. And so I think that I think that this 3, 4, or 5 years from now, I think that there's not going to be much discussion about the application of laws any longer.
You've mentioned funding through anarchism some organizations, and I personally happen to know people who have tried to fund, they call it humanitarian operations in Palestine,
Right.
and also in Venezuela, which is another sensitive case because they're in the middle of a trade embargo. And I know that also North Korea has tried to mine Bitcoin and send ransomware and ask for Bitcoin in exchange for the data. And I was thinking, do you believe that there is any geopolitical struggle involved with these decentralized assets?
Well, no, I think it's another tool that adversarial governments and entities can leverage. And your point about Korea, there are 200,000 people in China that are engaged in, working for the government, engaged in industrial espionage, Vlad. I mean, that's the number. And I know on U.S. networks in the United States, for tier 1 telcos, this is dated because there was a company that I had done some advisory work for that was in the business of securing tier 1 telco networks, and they were seeing incursions every day from places like Russia, China, and North Korea. And there's constant probing. And so, there is this is a form of, intelligence, cyber warfare, if you will, currying favor. We don't know everything that people are doing. We just know that there is a lot of activity going on, and it's organized by governments, and clearly the use and misuse of things like cyber currencies can be levered by governments in a wide variety of ways. And so for every diligent government and defense establishment, I think has an effort here to monitor and to create countervailing measures to defend their country against industrial espionage, against theft of assets, but this is sort of the age-old problem. This is not a new problem, right? This is something that's been going on. It's just that now the way that we do it has changed and evolved. People would take steal bearer bonds, right? And bearer bonds could be redeemed to finance something, and it's been going on for probably since the beginning of time.
Mm-hmm. Yeah, that's also a big issue in Romania right now.
Is it?
Yeah, with bearer bonds.
Oh, is it? Yeah.
With corrupt politicians who hold them in safes and keep them away in a very untransparent way.
Well, it's interesting. I'll make the observation that most senior members of the Communist Party in China, have assets outside of China. When you're dealing with a governmental system, which is what I like to describe as a benevolent autocracy, where things can come off the rails, and that there's not a lot of due process. Because the government effectively exerts full control over everyone. Not a lot of checks and balances, and I think that smart people create options for themselves, and I think that the Chinese are no exception. There's some very bright people over in China doing some very interesting things, and certainly the central government of China is a well-oiled machine. They do things actually incredibly well. Just look at their growth record over the last 20, 30 years, and but I do think that they also understand, if they're part of that government, the limitations of that government or the risks associated with that, and you see at least what I would describe as a lot of people creating hedges for their own families, and there were a lot of Chinese in the United States getting educated, for instance. Large population of people from mainland China here on student visas. So it's something that's with us to stay. Vlad is not, we'll have the same conversation a year from now, 10 years from now. There are people that want to avoid taxes, or people that, governments that want to keep money in countries and control money supply, defend the currency. There are people that want to get currency out of the country to create a hedge in case things, a place to go in case things deteriorate. And this has been particularly for, corrupt, in areas where there's a high degree of corruption, or there is a non-democratic and non-stable system. You start to see more and more of that kind of activity.
Mm-hmm. Yeah, I remember when I was in university and studying in Paris as an exchange, that the biggest book that they would discuss was The New Capital by Thomas Piketty. And to everyone in Paris, it was such a fascinating idea to have a global system which is fair and transparent in regards to taxes and income, to have this uniform, universal way of approaching financial issues, which is what Thomas Piketty has thought about. But the more I got into finance and the more I actually understood economics, I realized, even with the Panama Papers and all the reveals that were made, I realized that this is not as controlled as it seems. And now with cryptocurrencies, it's getting way more out of hand.
Yeah, well, I think, you got a new technology that's been distributed in the market, and there's a sort of like the early innovator, wild west kinds of days. And I think that as it starts to kind of stabilize and the winners and the losers are sussed out, then I think that the regulatory framework is developed and it plays a little bit of catch up. And I don't find what's going on to be that surprising in the aggregate. And I think that people are studying and learning about it on multiple fronts, and the regulators are, as I said, playing catch up. The governmental entities are playing catch up, and I think that a lot of this stuff is going to become old hat. If you look back 3 or 4 years from now, and already we know, tokens as securities, ICOs, they need to be regulated as securities. And we also know that there's very little that, there's all this discussion about what a utility is, but there's not much of what a utility token is, but there's not much market for utility token. And in point of fact, I would argue that utility token's been around for a long time. I mean, what do you call those crypto keys that you use to access a software license on your computer? I mean, that really is effectively a token. And so I don't think that, there are elements of the technology that have been around for a while that really are not particularly novel. I think what's novel is the way that we were, mining Bitcoin. We were in a highly decentralized fashion. Disintermediating the intermediators of financial transactions. And I think that that's kind of the innovation there. And, you may actually over time see more and more financial systems, move from from within a bank, into the cloud. But I kind of look at it a little bit and say it's interesting from a business model standpoint. I'm not sure, when we look back on this, 20 years from now, we're going to look at it as having been revolutionary. Because I think that everybody else will catch up. The systems will, the regulatory systems will catch up. The tax systems will catch up. And I think 20 years from now, we'll look at it again as being evolutionary, an interesting development in markets that changed and made more efficient certain kinds of processes. But I don't think that we're going to say, oh my God, the whole world changed. The whole world is not going to change because of the block, in my view.
Do you believe that the SEC will eventually approve the Bitcoin ETF?
It's a great question, and I don't have enough knowledge to know. I think that what the SEC is worried about is if the underlying asset there's two questions, right? For me, there would be, is the underlying asset corruptible, right? Because if they don't feel comfortable that this stuff can be warehoused, or that it can't, or that it can be that it can't be pilfered and stolen, the security aspects of it, then the answer is I would not approve if I was a regulator, right? I just don't want to put the public in harm's way. I think that the second issue is liquidity, right? And the ability to transact. And in the underlying Bitcoin, right? Because we're issuing a security, we're buying a bunch of Bitcoin, we're warehousing it. And so if the security elements and liquidity elements are solved for, then I think that there's no reason why they should stand in the way. but I think that those are two big questions, and they're probably going to require quite a bit of deliberateness on the part of the Securities and Exchange Commission to get comfortable with. You know, the SEC is not going to be rewarded for taking risks. If something blows up and it's on their watch, they will receive quite a bit of criticism. You know, the way the U.S. system works is that Congress appropriates the budget of the Securities and Exchange Commission, and what happens is because the SEC reports into Congress technically. I think that if something blows up, there will be hearings on Capitol Hill in Congress, and they will call the SEC chair to Congress to testify to defend what the SEC did. And so I think that they tend to be very, very deliberate in how they approach these kinds of questions, with a bias to making sure that it's done right. I think that's one of the reasons why people have so much confidence in the U.S. public markets, is because the SEC actually has a very good track record of getting things, right and transparent, and the disclosure is I think in the public markets is exceedingly well done.
Yeah, I agree with you, and I see this divide in the cryptocurrency community because, the early Bitcoin people were these anarchists who didn't want to have any connection with banks, and they wanted to establish their own parallel financial system. But as more investors got in, there is a higher interest for institutional adoption of cryptocurrencies. They want banks to maybe just buy 1% of their assets, to buy Bitcoin with 1% of their assets. And I think one of the pivotal points in my perception of how cryptocurrencies are viewed happened during the Milken Institute debate, which happened earlier this year. I didn't afford, and I couldn't afford to be there, but I've watched it online. And there was this person representing, I think it was the Federal Reserve. I don't want to say something wrong, but I think it was the Federal Reserve. And I think he was appointed by the Republicans because at the same time he was very libertarian in his speech. And he was saying that the best interest of the government is for cryptocurrency companies from the United States of America to succeed. And they want to be pioneers in this new field, and that's what they encourage instead of heavy regulation, which can stop innovation.
And I think that there is that underlying, that philosophy. I saw the SEC chair Jay Clayton back on September 19th in his office, and I think that they are very forward-looking. I mean, in the sense that they understand the importance of technology. The SEC's got a long history of embracing technology to drive down costs and markets and make things more efficient. It's a sort of worn view that they've embraced for many, many, many years. And if you read in his Nashville speech, which is up on the SEC's website, he will make that point. And so I don't see the SEC as being a bunch of Luddites by any stretch of the imagination. They are looking for how these technologies and cybersecurity, cyber currencies can be applied to the betterment and advancement of mankind. But they are sorry for the noise. That's one of my kids in the background.
Don't worry.
But I think that they do things with a certain deliberateness, right? And they're very, very slow because they want to get it right, or slower than we would like to see them act, and as people that are trying to get deals done. And I think what you're seeing right now with the Bitcoin ETF is that it's being held up at the SEC a little bit, so that they can make sure that they get it right before they do anything. They just don't want to make a mistake.
Do you see any difference in terms of how Republicans and Democrats handle the issue of cryptocurrencies? Because I see a lot of people discussing how the Obama administration was more, I don't know how to put it, was pro-regulation. But at the same time, as soon as the Trump administration stepped in, they were more hands-off in regards to the entire blockchain industry. And I see people posting every day and being Republican, maybe not because they believe too much in the Republican platform, but because they seem to favor cryptocurrencies much more.
Yeah, I don't know. I think sometimes, you're bringing the biases of some of the Democrats versus some of the Republicans to bear. I mean, there are more people with business backgrounds that are Republicans in Congress than there are people on the Democratic side of the aisle, and a lot of them are representing sometimes, poor constituencies. And so, I've had a very good experience with both Democrats and Republicans working with both of them. But it's really the Jobs Act was amazingly bipartisan. We had an overwhelming majority of Democrats and an overwhelming majority of Republicans support it. And the way that it got actually through the Senate, because it was a bill that really largely started in the House of Representatives, was because the White House under President Obama, my understanding is that President Obama hired 2 lobbyists to tell the Senate Democrats that he wanted a bill. And so, I think that if you look at what we call Jobs Act 3.0, which includes venture exchange legislation in it that I've had a hand on, it made it through the House. We'll see if it makes it over to the Senate, but it passed the House of Representatives 410-4. I mean, overwhelmingly bipartisan. And so I think that, what we can do with capital markets and well-crafted, legislation that creates incentives is we can ultimately, change markets and restore upward mobility in this country, which is very, very important to, Democrats and poorer people. I mean, to try and create a slice of the American dream for people that they can actually go out and grab, that we can uplift poor communities in the process using that sort of, that greed instinct that people have by getting entrepreneurs to focus, by putting jobs into targeted economic development zones. There's all sorts of things that we can do with sort of pro-capital markets legislation that's, well crafted. And I think that getting together, with Democrats and with Republicans who kind of share these kinds of, ideals for a better company. We see politics, on TV, okay? But politics is very different one-on-one with a politician. And those politicians are not, they sometimes pander to the media because they're running for office. Every time they're on television, like with the Kavanaugh hearings and everything, they're being seen by their constituencies, and their constituencies are voting for them. And so they tend to come off as being less reasonable and more extreme than I think that when you get with them one-on-one and you're working on policy, they actually are. I mean, I've actually found, I used to use the case. There was a guy that ran, a Democrat that ran the House Financial Services Committee years ago named Barney Frank, and he was the first openly gay member of Congress. He was actually from Massachusetts, which is a very liberal, area of the United States. And sometimes he came off as, extremely liberal. And, when he was on TV. But if you met Barney Frank, he was a Harvard Law graduate. And Barney, actually one-on-one, when you were talking about policy, he was very smart, very gifted. And I think that one of the reasons why he was effective within Congress crafting legislation was because, he was not this persona that was really, projected for the purposes of having to run for office. And so I think that I think that the one thing that I would say from having spent quite a bit of time, in the House and in the Senate with staffers and whatnot, is that there's a lot of people behind the scenes that are doing a lot of very buttoned down work that are coming together. And I think that, when we're working at things very deliberately, I think we tend to come out with a better legislative product than when all of a sudden we're rushing because there's been some kind of crisis like we did in the wake of the credit crisis, and there's some sense in my mind that legislation is in many instances become overly broad and overly complicated. So for instance, Dodd-Frank, I think ended up in the final Federal Register to be over 900 pages. And you could argue that Dodd-Frank replaced Glass-Steagall, which was very simple for many years and separated the risk businesses from the lending business, the depository institutions. And that was only 35 pages. And so it got repealed in 2000. It probably created some of these circumstances like too big to fail because it wasn't well thought out legislation. In my mind, they did a range of things. It was actually under the Clinton administration. One of the great sort of misconceptions in the market is that, the Republicans were the ones that blew up the economy through the lack of regulation. And in point of fact, the lack of regulation that came to bear was signed into law almost exclusively unilaterally by President Clinton back in the late 1990s, going into 2000 timeframe. It was Gramm-Leach-Bliley, which effectively repealed Glass-Steagall and the separation between the depository institutions and the risk businesses, which created the financial supermarkets and too big to fail. It was liberalizations of the Community Reinvestment Act that relaxed credit mortgage standards and led to liar loans and all the mortgage credit crisis. It was the Commodities and Futures Monetization Act of 2000, which took the restrictions off of derivatives and effectively gave us infinite derivatives without any kind of understanding of things like counterparty risk, right? So when you put all of that into a bundle and you say, okay, who was responsible? And I would say in the defense of President Clinton, most of this legislation was drafted by a Republican Congress, but it had to make it through Congress. It was bipartisan, and then it made it up to the president's desk, and he was a Democrat. He signed it into law, and it was not well thought out. It created a series of liberalizations without the required controls in place. And what did we end up with? We ended up with a credit crisis on the scale that was such that had it not been for Hank Paulson, who was the Secretary of the Treasury at the time, wrapping the full faith and credit of the U.S. government behind the money center banks, the financial institutions, we would have been in this world, we would have been in another Great Depression. As it was, we ended up with a Great Recession. And so I think that, it's one of the reasons why I think that getting legislation right and understanding, where things are going. I'm a little bit concerned, I have to say, that, that financial markets are so complicated. And the average legislator is an inch deep and a mile wide, and this is not their core competency, right? They do not come from this business. I think that even on Wall Street, very few of us tend to have very broad field vision and understand holistically these large systems and how they work. I mean, I'm concerned that the linkages with computers, which create hair trigger sort of situations where if there's a major event and all the computers say sell, 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 it's not just stocks. They're hooked into derivatives in a way that they weren't before the explosion of computers. It'll sell, debt down, equity down, futures down, hard assets, everything will go down. And just because investors will start out with computer systems triggering things and then when markets go down a certain amount, it undermines consumer investor confidence. Investors start taking money out of major institutions, which then precipitates a snowball effect. Mm-hmm. And I think that I always worry that the regulators don't understand this holistically well enough to be ahead of it. And more and more and more of the kinds of investment strategies are devoid of people, because running money with computer-based systems is cheaper to do, more efficient to do than it is to do hiring people to do fundamental research. They've also taken a lot of the buffers out of the system because they collapsed in the interest of making markets more efficient and transaction costs lower. They collapsed trading spreads. They did this in equities. They're doing it in fixed income. And because of the self-directed movement, we've moved from retail brokers advising on securities transactions to they've all become asset gatherers, and nobody's talking stocks or bonds any longer. And so that intermediation that created a buffer in the system and somebody to talk to has been taken increasingly out of markets. And so as a consequence, I think these markets are much more vulnerable to sort of cascade effects than they have been historically. And we're trying to do some things with, with stops in markets, but I'm not sure it's enough. I mean, at the end of the day, you really don't know how these markets are going to react till you get into a really high stress environment. And as we saw back during the credit crisis, they did not act well, right? Every asset class in the world went down in price, with the exception of major sovereigns like the U.S. Like U.S. Treasury bonds, right? People would not put their money into the banking system because they were afraid that the banking system would fail. And you could see the evidence of that because when they bought 30-day, 90-day T-bills, they were trading at negative returns, meaning that they were paying the U.S. government, the U.S. Treasury, they were paying them money. They were willing to take a loss just to know that at the end of 30 days or 90 days that their money would be there, right? And it was really kind of it was the first time I'd ever seen that. I was actually at BlackRock, which is now the largest asset manager in the world, and I was in the office of the guy that ran equity trading, looking at his Bloomberg terminal, and when I saw that the treasuries were flickering with negative rates of return, and I asked the guy who ran equity trading there, I said, is that a misprint? And he said, no, he's been watching it all day long, and it had been flirting with zero, and it's just gone negative. And I said, and I got chills because it said to me that the world no longer has confidence in the banking system. So, hats off to Hank Paulson, because what he did at that particular point in time probably saved the world's economy. This is the former Secretary of the Treasury, who's actually the former CEO of Goldman Sachs. There's a couple of what I would call really under the gun kind of important moves that people have made in my lifetime. That was one of them. The other one was when that air traffic controller grounded all the flights on 9/11 in the United States because there were other planes that were likely to have been hijacked, and so the call that he made probably saved lives. And so it's people under pressure doing, I think, making extraordinarily good calls, and probably not enough. Hank probably doesn't get enough credit, but I think he saved the world from a Great Depression by what he did there.
Yeah, and I guess that's one of the reasons why Bitcoin got so big, because it was launched at the right time, and it benefited from the sympathy and the understanding of people who are disillusioned with the banking system. Which is ironic, because now it's trying to blend into the system that it resented in its first days. But I just have one last question, because I want you to have breakfast with the rest of your family, and I feel bad already. But do you have any investments in cryptocurrencies, or do you have any projects which you really like, or you look forward to seeing how big they can get?
Well, I think that, give me 1 second. My wife locked herself out. Yeah. I'm active, but not so much in the cryptocurrency areas as in tokenizations of securities, because I think that that's an area that ultimately will explode. Largely because I think that tokens can essentially activate a whole series of back-end processes that take a lot of the operational inertia, friction out of the equation. Whether it's KYC, know your customer, whether it's Patriot Act, anti-money laundering through authentication. You could trade, in theory, through accredited investors in private markets much more efficiently, private placement securities. And so I think that just the ability to automate all the paperwork that's required by this is going to make private markets more attractive. But Alchemy Coin's interesting. They're looking at tokenizing credit CDOs, credit debt, collateralized debt obligations, and doing peer-to-peer investing. We have a series of Christy, please, give me a minute. No, we're wrapping up here. And I'm an advisor to Templum, which got the first license or approval from the Securities and Exchange Commission to act as an alternative trading system for tokens as securities. I have working with CoreConnex, which is a Canadian company that's doing tokens as securities for private companies. So, we think that it's going to take a while for this stuff to develop, but we think that it has some significant utility. One of the things that I tell folks is that I like to see, if I'm an issuer as a public company, ultimately, I don't really I want to be able to raise capital most efficiently first and foremost. And for me, that means that if you're an investor, I would prefer to be able to give you, if you want a token. If to evidence your ownership in my company, if you want a traditional security because that's the way you want to hold it, I should be able to do that. And I think that one of the things that a lot of the people that are working in this space are missing is that they want to, right now they want to do an issuance of just nothing but tokens or just traditional securities. And I think that if you want to increase the demand, you should make the two kind of interchangeable. At some point, tokens may displace traditional securities if they turn out to be more efficient from a settlement standpoint, from a processing standpoint, but they're not anywhere near there yet. And what you do by tokenizing securities is actually you limit the market because there are many traditional institutions that just won't take a token at this point in time.
Well, thank you. And Mr. Weild, I feel like I've learned so much in this hour while we spoke. There's a lot of information which I had no idea about, and I guess this is like an introduction for me to make more research.
Well, I have been doing it for a long time, as I like to say. So hopefully I've learned a few things along the way. But you call me Dave or David, but Mr. Weild makes me feel awfully old.
I feel the same personally, but I'm 26 and some people just call me by my last name and I say, no, that's my father. You can call me Vlad.
Terrific. Well, nice to meet you on Zoom and nice to talk to you. We obviously know quite a bit about it. You've been doing this, so you're obviously pretty bright. And look, I mean, the nature of markets and businesses and everything is that the teams win, and nobody knows everything. I mean, that's one of the things you learn. I think when there's a great expression which is, when I was young I thought I knew everything, and now that I'm old I think I know, I realize how little I know. And that's the fact of the matter is that I've accumulated quite a bit of knowledge. And I know a lot more than most, and I'm probably in some respects some people consider me probably the foremost expert in the world on how market structure impacts capital formation. And but I would tell you that one of the great things about being born at this point in time is that there's always so much more to learn, and there's so much happening that you always have this uncomfortable feeling that you can't possibly know enough. So anyway, but it makes it interesting. It makes it fun. And I've spent, my life in the capital markets and, helping growth companies access capital. And I would tell you that, it was what got me into the business, 35 years ago was what we used to call the God's work of investment banking, which was actually getting capital into businesses that were going to really make a difference in people's lives, and whether it's life sciences and finding cures of cancer or alternative energy and renewable energy and, were baseline innovations that lay the groundwork to be able to do these things. I did a lot of work on a lot of semiconductor companies, capital raises years ago. I visited an awful lot of clean rooms, and in Silicon Valley, Applied Materials was a big listed company, the NASDAQ stock market. It's the largest semiconductor capital equipment company in the world. And I think that, people, don't appreciate sometimes the scope of human energy and involvement that has created amazing systems for the improvement of everyday lives. Just the fact that we can do this on a call requires so many different types of technologies to come together, so that I can see you in Romania and you can see me here in Westchester County, New York. And it's really pretty remarkable. And that's occurred during my lifetime. I was a kid and I remember looking at a black and white television. That was what we looked at. And, not that much before that, it was a radio that people listened to. And the world is changed in many ways for the better, and people's quality of lives have improved. But I think that we have so much more that can be done. And I think that that's what makes, doing what I've been doing for my whole life to be so incredibly important to do well. And I get very, very frustrated when people, misuse the legislative process to create things that will enrich themselves, but don't necessarily contribute something to society at large. And I think it's one of those things that I think all of us need to get in touch with our, develop sort of a moral and ethical code that helps us do things that are going to be constructive in society and not disruptive just for the sake of disruptive and enriching oneself. And I think that there is there are a lot of people that unfortunately engage in unilateral self-interest as opposed to, I have no problem with self-interest as long as it's driving to a goal which contributes something positive to the marketplace, to society. But there's a lot of people out there that I think need a little bit of an education on ethics when it comes to markets and business. And hopefully, I think that this next generation, kids your age, tend to be a little bit more mindful of that stuff, Vlad. I really do. I'm encouraged by some of the aspirations that I hear coming out of young people. And so, maybe we'll be better off for the contributions. I hope I'm around long enough to see the contributions of your generation.
Yeah, and I think you have had the same kind of generational difference with your parents. I guess they didn't agree with credit cards and electronic money as much. Maybe they believed much more in hard money, something that they can touch and they can perceive as such, as something material. They don't understand this world of virtual money.
Well, then I think that, let me tell you, my parents, who are about 88, 89 years old, they have embraced credit cards, and they did a long time ago. So they may not have been the early adopters of it, but they were, but they certainly, people do adapt, and they do adopt. And my guess is that if cyber currencies start to become more ubiquitous and there are fewer risks around it, I think what we get concerned about is that if you take, you take Bitcoin and you put it onto a fob and you lose that fob, you're in trouble, right? And I think that there's a lot of us. I mean, I've broken computers, I've had computers stolen, so the whole safety aspect of it is just something that I think is not well understood by a lot of people unless they have a lot of time to kind of research it. And look, when you're young, you have more time to explore. I mean, that's what we do. We send people to college, we send them to graduate school, they explore, they learn, and they're also dealing with other kids who are people their own peer group that are involved in the new thing and the exploration. And so consequently, I think that's a much more fertile environment for people to do innovative things and to embrace innovative things. I see that with my kids in high school, and the kinds of apps that they gravitate to. And I mean, my 15-year-old, I think he was probably 8 years old when he first jailbreaked his iPhone, and has got him. I think he was probably 11 when he already was exploring the dark web. I think he pulled out of it because he was afraid he was going to get into trouble. But I can tell you that those are two things that I have never done. And it's but that's the nature of the beast. I mean, the rest of us, I think through our accumulative knowledge as we get older, and we've seen a lot of this stuff, it's our jobs to make sure that people, through sort of their singular interest and innovation, don't do things that they don't understand that will cause harm, broadly in society. And I think that understanding the broader implications is something that tends to come with a little bit more age and wisdom, and having lived through a whole series of different man-made, near economic calamities. I mean, I could go back to the Resolution Trust Corporation, the crash of 1987. I can look at the dot-com bubble and what I affectionately call the bubble rubble, which was the aftermath of the dot-com bubble, and what Alan Greenspan, who was the head of the Fed, used to call irrational exuberance. These massive bubbles, and then going through, obviously up to date, the flash crash, the credit crisis. I mean, living through crises gives you a certain amount of perspective. I had to work on 9/11 on getting the stock markets reopened. And I worked on putting in share repurchase programs before the stock markets reopened with major corporations to make sure that there was a safety net of buying to hopefully stabilize, if you will, investor sentiment. Because if the stock market had gone down more dramatically than it did, it would have had a knock-on effect. And so, the only reason why I understood to do that was because I had the experience of living through the crash of 1987 and understanding that it was the corporate share repurchase programs that came in after the major sell-offs that started to give institutional investors and traders more confidence that the world was not coming to an end, that the corporations were taking a stand. And so, I think, as we say, knowledge is power, and I think experience begets knowledge. And so, as a consequence, I think that there is a bona fide place for people of a certain age to help maintain order and hopefully set guidelines and rules in ways which are going to avoid, not impede the exuberance, but at the same time, not lead to catastrophic outcomes. And I think that's the art. This constant push-pull between technology and innovation and then regulation and rulemaking and enforcement, and the two work together, and there's a reason they do, and I think it's important to try and get both of them right. But that's sometimes that in and of itself is more art than science.
You know, when we discussed about having this interview and I looked up your Wikipedia page and I saw that you worked at NASDAQ and that you took place and you're what they call the father of an important piece of legislation, I actually thought that we would have many diverging opinions regarding cryptocurrencies. But what I found is a very moderate and diplomatic approach, which is open to the innovation, but at the same time tries to preserve what we have as a stable system, which has proven to work over time. And for that, I feel grateful. And like, you're like this father figure who understands like we're this new generation of people who want to innovate in this financial field, but at the same time, you remind us of the values that we should be keeping just because they maintain, they're like a safety net to the entire system. So thank you for that. I appreciate it.
Well, it's I spent most of my career working and working with growth companies and innovators, and so I think that this generation looks at this innovation and looks at maybe the older generation as being a bunch of Luddites, but in point of fact, we spent, when Apple went public, when Microsoft went public, when Intel went public in 1971, I mean, these were the innovators of their time. And those were massive innovations. I mean, they created tectonic plate shifts in terms of how business was done. I mean, if you look at just the insight with Office, where, Bill Gates took, spreadsheets and integrated them with a word processing application and PowerPoint. You take that for granted right now, but that just the spreadsheet was an innovation to financial services. I mean, we used to do these things by hand with a pencil and a gum eraser, and it totally transformed how much analysis we could do. It augmented it by orders of magnitude, and it probably enabled the private equity business and certain types of financial engineering. And so, at that point in time, that was as innovative and radical as things like Bitcoin and the blockchain. And as the French say, plus ça change, plus c'est la même chose. The more things change, the more they stay the same. And so I think that that people of my generation, particularly in important positions, like Jay Clayton, who's the SEC chair. And by the way, I'm very excited about him as the SEC chair because having known the SEC chairs going all the way back to Arthur Levitt, and I have a great deal of admiration and fondness for each of them. I mean, they've been great public servants, but Jay has real expertise in capital markets. I mean, that's really what he did. Mary Jo White came out of Debevoise, and she was a federal a state's attorney, federal prosecutor. I mean, she's a heck of a U.S. patriot. She was the one that put the blind cleric, the terrorist, in jail, and but her expertise was not capital markets. And Mary Shapiro ran the intermediation, what do they call it, the arbitration dispute resolution side of the NASD, which was the precursor for FINRA. And so when you look at people's backgrounds, I mean, this is the first person in a long, long while who grew up in capital markets doing, equity capital raises and related things, doing financings as a lawyer. And I can tell you from my meeting with Chairman Clayton that having done the job of pricing, and distributing securities in an equity capital markets equity syndicate group at a major firm, he has really in-depth knowledge of the process. He has a lot of expertise, and I think that that's going to be very helpful to the SEC over the course of his 6-year term. I hope he sticks there because I think he's going to bring a lot of value to that institution. We'll see. And I think that will bode well for tokens as securities and crypto and everything else, because he's He's very intelligent, very knowledgeable, and his expertise is closer to being in the areas that we're discussing than not, and that's a bit of an anomaly for an SEC chair in my experience.
Okay, so I think we should wrap this up. I will split this in two parts, I think, and post it throughout the week into different parts so it's easier to digest, because I guess nobody would watch 1.5 hours of video.
Has it been that long? Yeah, sorry. Okay.
No, you don't have to apologize. This was illuminating in a way and relieving, knowing that there are people who look at it objectively and not, from statements like the ones from Nouriel Roubini.
Yeah, he's been a topic of a lot of discussion in groups that I've been at, and particularly his Senate testimony. And I think that a lot of people that know a lot about crypto and and blockchain in general, we're not overly impressed with Nouriel Roubini. He's got a big name. I'm not sure there's a lot in his background that he's an economist, that really would inform him adequately of what's going on in this industry. I may be wrong. He's entitled to his opinion, obviously, but most of the people that I respect that really spend a lot of time in this area, and they're friends of mine, like Lou Kerner, are not fans. Do you know Lou?
No.
Lou Kerner's an analyst. I mean, he was an internet analyst originally on the sell side, and he's moved, over into blockchain related matters. So he was an equity research analyst, venture capitalist for quite a bit of time, and I just saw him out at the Crypto Invest Summit out in Los Angeles it might have been last week or 2 weeks ago. So.
Okay, I guess I would love to interview him. If you can send me his contact, I will just send a proposal for an interview.
I will. Yeah, he's very good. Yeah. Enjoy.
Okay. Thank you very much. This was really great. And I'm going to send you the end results.
Okay. Nice to talk to you, Vlad. Appreciate it.
Bye. Have a nice day.
You too. Bye-bye.